Hi everyone, Kathleen here, Research Director at XTB. What a week it's been. The UK election is over and we have a new Labour government in the UK with a large 170-seat majority. French elections are also over, where the results saw a surprise win for the left-wing alliance, which has managed to keep the far-right National Rally Party out of power, but they've not won enough seats to form a working majority government. This means that France has a hung parliament, and it could take many weeks or months of political horse trading before a French government can be formed. The market reaction is fairly muted. The pound is rallying and is one of the top performers in the G10 FX space since the election result. The new government has already enacted plans, including well-flagged planning reforms, to boost UK house building to 1.5 million homes in 5 years. The UK home builders, including Taylor Wimpey and Persimmon, are in the top 10 performers in the FTSE 100, and they both rose nearly 7% in the past week. Also, the domestically focused mid-cap FTSE 250 index is outperforming the FTSE 100 since the election, and this may continue as the focus shifts once more to the UK as a place for inward private investment and an upgrade to UK infrastructure. The 2.5% increase in the FTSE 250 in the past few trading sessions is a sign that Labour's growth message is resonating well with investors for now. Overall, the political risk premium that has hindered UK asset prices in recent years is getting eradicated, and this is positive for UK financial markets in our view. Added to this, the Labour government is a stable antidote to political disorder in France and also concerns that President Biden will pull out of the Democratic race to become the US president, opening the door to another Trump presidency next year. Interestingly, in the US, the main blue chip stock indices reached fresh record highs last week. However, the Russell 2000, which includes mid-cap US stocks, underperformed the S&P 500, which is a sign that firstly, mid-cap US stocks are impacted by the political turmoil, and secondly, that mega-cap tech stocks, which continue to power the blue chip indices to fresh gains, are immune from these concerns. Elsewhere, the focus is also on central banks, as the markets have been increasing expectations about rate cuts in the coming months. The market is pricing in a 65% chance of a Bank of England rate cut next month, while it's pricing in a 75% chance of a Fed rate cut in September. US CPI for June is released this week, along with the Fed chair testifying to the US Congress. If we see the disinflation trend continue, then we may see an increase in bets for a US rate cut in September, which may weigh further on the dollar and US bond yields. We also get the start of the second quarter earnings season, with the US banks reporting Q2 results on Friday. That's all for now. Thanks for joining.